This episode is brought to you by SS&C Mineralware. Are you managing mineral assets and feeling overwhelmed? Unsure if you're getting paid what you're owed? SS&C Mineralware is here to simplify the management of your minerals, royalties, and non-operated working interests. Mineralware's out-of-the-box features give you the tools you need to visualize and keep track of all of your assets in one place. Mineralware lets you know in seconds where your interests are, what's active, what acreage is open for lease, and if you're getting paid what you're owed. With Mineralware, you can even automate your revenue and JIB processing and eliminate tedious manual data entry, allowing you to focus on more pressing issues. Thousands of mineral owners rely on Mineralware to keep their mineral management simple, automatic, and all in one place. Take control of your mineral assets today with SS&C Mineralware. To see a demo, you can visit their website at www.mineralware.com. That's MINERALWARE.com.
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to do a deep dive on lithium and the outlook for the industry in the United States, some of the latest developments in different basins and states where there are some lithium pilot projects and how that might develop into the future. And then we'll do a deep dive on the economics of one of the most advanced or most furthest along projects in Arkansas that is a joint venture between Standard Lithium and Equinor. And we'll go into that because it's a publicly traded company, and some of those numbers for the pilot project are available. And we went through and did a bit of an economic analysis, and we'll talk about, how much are they really making with this, and what's this going to look like as the industry develops, and what kind of prices do they need to break even. So, Justin, this was interesting as we hit record. Shout out to fellow Narrow board member Lana Straub, our Texas chapter president. She had shared some articles on lithium with us, and we wanted to take that and do a little bit of additional research and do a little bit of a deep dive here.
You said it, Matt, and it's, lithium's been all the talk, I would say, in 2025. So as we come to a close, I think it's also fitting to kind of look back on this. And there's so much going on in different states from a ownership standpoint and different pilot projects. But Matt, kind of setting the stage, we've talked about it before. The old way of lithium was to do large evaporative ponds, and that's not the case anymore. We've got new methods, and one of the ways of doing that is by taking wastewater from oil and gas extraction and using filters to filter out the lithium. And so that's kind of the process that we're talking about here. They seem to be popping up all over the place, man.
Yeah, it really is popping up all over the place. There's certainly plenty of demand for lithium. The numbers look like right now we need 500,000 metric tons of lithium annually by 2030 to meet electric vehicle goals. And so that's basically those targets that the government has set and states have set around, hey, we need to have a certain number of electric vehicles or battery hybrids or whatever. And that takes a lot of batteries that go into those vehicles, not to mention everything else that we have that's battery powered. You buy things that have lithium batteries in them, from toothbrushes to battery, USB power banks to radios to, you name it. Everything anymore is rechargeable, right? So that has a lithium battery, by and large, is the primary technology that we're using for those rechargeable batteries. And so with that, the thing that we've got in place right now, we produce only 2,700 metric tons per year. So there's a huge gap between the domestic lithium production and where we need to be self-sustaining and to be able to meet the majority of that demand or needs that we have domestically. And right now, we have to import most of that. And it's from countries that are maybe not favorable to us, or maybe that we're getting into a trade war with. And so there's a real strategic need, I think, to ramp up our lithium production here in the U.S.
Yeah, you said it, Matt. Interesting that the wastewater is really where we're going to turn to this. And, this was a burden truly years ago. And Matt, there's some really high concentrations in the United States, or at least comparative, just to give an idea. In the Smackover, there's 668 milligrams per liter, which is a concentration that's relatively high. And there's the different pilot projects, like the Pennsylvania pilot project for the Marcellus Shale, and they're kind of at different stages. So I thought it was interesting, Matt. Do you want to talk a little bit about what they're actually doing and how they're getting this lithium extracted? So I thought it was interesting that it talks about that the different areas require some very specific requirements, which would make one area more profitable than another area.
That's a great point because, even though you may have enough lithium there on paper that it would make sense to, commercially develop it and to extract the lithium, but the water chemistry may be difficult. There may be a lot of impurities or heavy metals or things you have to deal with that increase the expense of extracting those waste chemicals and materials out of that brine in order to leave the lithium carbonate, which you need for that, mass production of batteries, and they need to have it at a certain level of purity, and none of those impurities in there because that's going to affect the ability to make a battery that's going to work properly. And so what that may mean is that it's more complicated to get the lithium carbonate extracted, maybe more expensive. And so this is a burgeoning industry. It's definitely not something that's very mature. So like that direct lithium extraction technology that they're using in these shale plays. So it's basically taking the water that's produced as a byproduct of oil and gas production. And then if it has a certain amount of lithium in there, make financial sense to extract the lithium and then monetize that as well. And then deal with the water and then be able to treat it and then re-inject it and things like that. So that direct lithium extraction technology uses filters and membranes to capture the lithium directly from the brine. So you can imagine a big plant where the water stream where that brine comes in, one end goes through several different chemical processes and different units. On the other end comes out the lithium carbonate and then the water and the other byproducts. And so it's being tested in several shale plays, like you mentioned, Justin. I think Pennsylvania, I heard, is a pilot plant is currently extracting lithium, or they're doing it. Whereas when we first mentioned that lithium in Pennsylvania, there was a study that was done, and we'll link to that episode in the show notes where we talked about that. But it was more of a theoretical thing at that point in time. I think at that time, a year or two ago, there weren't any real pilot projects or anything on the ground going on. But since then, there's been some activity. And then other areas like the Permian, there's been companies that have successfully produced lithium carbonate from the Midland Basin, in particular, part of the Permian, kind of the east side of the Permian Basin. And so they are, doing some testing there, and there's talk about commissioning a full-scale plant for commercial production. So they were kind of in that pilot phase as well with, plans to move forward with it. And certainly there's plenty of produced water coming out of the Permian Basin. Permian alone produces over 20 million barrels of wastewater per day, according to some of the research that we did. In the Bakken, for example, that's about 1.5 to 1.7 million barrels per day. And then, like we mentioned, that there's high concentrations in Pennsylvania. So there are different areas around the country that are sort of emerging as places where lithium is being explored and may be something that they pursue commercially. That's in the Permian. Then the Smackover, like Justin mentioned, which is East Texas and Arkansas. Then you have the Bakken in North Dakota, and then Appalachia, the Marcellus and Utica. So that's Pennsylvania, Ohio, and West Virginia. So I would say those are kind of the three areas where this seems to be the most activity at this point.
You said it, man. And it's kind of from all angles. Not only are they looking at, like in Pennsylvania, where they have the infrastructure actually doing this with produced water whenever it's produced as part of the process, but in Texas, some are exploring looking at old saltwater wells and producing from those and for supplying lithium. So it's kind of an all-pronged approach. And that really, I'm sure, comes down to economics, which really is the burning question for everybody. Matt, we talked about Arkansas, which they were kind of the leaders on really talking about royalty rates for mineral owners. And when they released the royalty rate, everyone thought, oh, that's a bit disappointing. But they were the first to take a stand. And every state kind of falls a bit different when it comes to the property ownership. So while things are going full speed ahead, there's still some big question marks on who owns it and how much is owned.
Yeah, that's a great point because, you'd think that if it's a byproduct of oil and gas production, the mineral estate owns the oil and gas and other minerals. And if lithium is one of those other types of minerals, it would stand to reason that the mineral estate is the owner of the lithium and should be the one getting paid royalties. However, there's some uncertainty and some ambiguity in different states. I would say Texas has one of the least clear ownership frameworks around that because there have been times where there's been rulings that come across that say, well, actually the produced water belongs to the operator, for example. And so if that lithium is considered part of that produced water, by virtue of that, could the operator take custody of it when it's produced? It's a byproduct of the oil and gas production. It's not considered part of the mineral estate. That's a possibility. There's questions as to, typically I'd say the water belongs to the surface owner. And if that brine is considered part of the groundwater or part of the water belonging to the surface estate, well, then does that mean the lithium producer needs to pay the surface owner and not the mineral owner? And there's some questions about that. And, the general gist of it in Texas is that legislation needs to be passed or case law needs to happen that clarifies this. And so there's going to be a little bit of ambiguity. And probably as a result, you'll see producers do things like ask for stipulation of interest, which, between both the mineral estate and the surface estate to say, okay, you all agree you're going to take this percentage of the lithium, and then, everybody signs it, and then everybody's happy because that's a binding document, and then they can go forward and develop the project and then pay without risk of paying the wrong people. But until then, and that's something that would be difficult to do on a case by case or project by project basis with, thousands and thousands of owners. It'd be sure a lot easier to have some very clearly defined legislation that says, here's who owns what, and here's how you pay them, and here's the framework for that. I will say on the scale of ambiguity to clarity, Texas is probably on the more ambiguous side than probably Pennsylvania. And then you have Arkansas, where it's very clear because they've passed a lot of legislation. And it's because there's a long history of brine production in Arkansas for bromine and then and other things like that. So they have a framework in place, which is good. The bad thing about that, like we've reported on in various news episodes, is they recently passed the statutory royalty rate for lithium in Arkansas at 2.5%, which is well below the norm for oil and gas royalties. And many states and other listeners that I've spoken with and narrow members that I've communicated with, they've mentioned that they, in East Texas, they were able to negotiate royalty rates much closer to the standard for oil and gas. So, if you look at across the state line, the resource may be pretty similar, but the amount that the royalty owners in Texas are going to get paid is, multiples of what the Arkansas royalty owners are going to get paid, which is really unfortunate. I think Arkansas, the Arkansas mineral owners got the short end of the stick with that legislation that was passed.
Yeah, you said it, man. And there's so many things to work out. I'm sure it will work out as time goes. But really, I think the moral of the story for mineral owners is that lithium is here to stay. And if you're going to be signing a lease or have an opportunity to, change documents or discuss it with an operator, it's something worth bringing up to see if you're protected for one in a lease or your documents and if they have plans.
Yeah, and I think the moral of the story there is if your approach to lease for lithium is to get a really good attorney that's got some experience with lithium leasing. So typically that would be like an oil and gas attorney that's also kind of getting into that space. And they can help you negotiate the best terms possible for that lease, because I think there's probably initially going to be a lot of latitude to negotiate those leases. And so you want to try to negotiate the best agreement possible before that goes down the road and is, held by production like an oil and gas lease. So yeah, Justin, let's talk about shift gears a little bit and talk about the economics of these projects. So we wanted to do a deep dive today on, are these projects really that profitable? How much are these companies looking to make from this? If they're paying 2.5% royalty, what does that mean? Are they making windfall profits kind of a thing? And then, taking advantage of those mineral owners, or what do the numbers look like? And so we tried to do a quick and dirty analysis of this. And so let's get into that.
It's really interesting. And I think this is really the burning question, because there's always that assumption that there's a lot of money flowing and maybe we're not being fairly paid. And Matt, to kind of set the stage, current lithium carbonate price is $10,000, $11,000 a ton. And that's down from $80,000 at its peak in 2022. So the break-even estimate for this project in Arkansas specifically is between $15,000 and $18,000 a ton. And that's based on using the direct lithium method. And at $25,000 a ton, the project could generate pretty strong returns. And the other factor playing into this is that you've got government subsidies, which is a lever that can certainly be pulled to grow higher as we try to compete there's been some global competition and depressing the price of lithium. And so I think there's the anticipation there that maybe this isn't necessarily the market price, but a depressed price intentionally in the global scale.
Yeah, that's a great point. Before we hit record, we were talking about how China has just flooded the market with electric vehicles, and they've gone from really a footnote in vehicle production globally to one of the largest manufacturers of cars, at least countries that produces. I think they're the largest now, in fact. And that's over a very short time period. They've ramped up production to that level. Part of it's to meet domestic demand because they need more electric vehicles to reduce the air pollution, which has really been an issue in some of the larger cities in China. And also, in the meantime, they've been exporting, I'd say outside of the United States, most of the other countries and continents are, seeing a lot of Chinese vehicles hit the market. It's been different here in the US, but there's probably just a matter of time before that changes. Similarly with lithium, so China is the largest producer of lithium. And so they, with the government control over production, they can pull some of those strings that we can't here in the U.S. because if it was not profitable to do something, company wouldn't do it because they'll go out of business. Whereas if it's the Chinese Communist Party that is pulling that lever and is the owner of the company, they don't care because they'll just subsidize, add additional subsidies so that the company can still be making money. And in turn, their goal is to maybe crush some of those capital markets or the producers that are capitalists and, need to make a profit. So they can, artificially increase production to drop prices to put those companies out of business so that they maintain market share. So I think that's a significant risk with the lithium industry as a whole. And I would say in general with these, maybe less so with the other critical minerals because it's a little bit harder to ramp up. But like lithium is pretty plentiful and we have a lot of it here. And there's definitely a lot of projects happening. And you think about it from like oil and gas and the shale producers, it's kind of akin to like what OPEC does to oil prices. And what they did during the price wars in like the 2020, they flooded the market with oil when prices and demand was down, caused prices to go negative. And, that's a real threat here, I think, to the lithium industry here in the U.S. What exactly happens, we'll see. But, it is a risk for these companies, I think.
You said it, Matt. And I think we may see that offset as years to come with more government subsidies as well. And with this project, Matt, so the phase 1 target was 30,000 tons per year per annum of lithium carbonate equivalent. And the ultimate target is over 100,000 across multiple phases. So, Matt, this is pretty ambitious. Even the phase 1 target seems like it's pretty ambitious. That would be exceeding our annual production currently across the different sources. But they are, making their way. And there's a lot of commitment, both government and private, to make this happen.
Yeah, and they've been running a demonstration plant in El Dorado, Arkansas since 2020. This phase 1 commercial project, they're targeting first production in 2026 to 2027. And they have a proprietary direct lithium extraction process that they're using. And so diving into the numbers, so basically looking at their financial disclosures for Standard Lithium, which is a publicly traded company. I think the ticker is SLI if you want to pull some of those documents. And then also this pulled from comparable direct lithium extraction projects where there was data available. So the phase 1, the 30,000 tons per year, the particular numbers we're looking at is the direct lithium extraction facilities in the $150 to $200 million. Lithium carbonate conversion plant is $200 to $250 million. The infrastructure, contingency, all that stuff, you're looking at around $460 to $625 million. So that's a pretty big range. What that breaks down to on a per ton per year basis is between $15,000 to $20,000 per annual ton of capacity. So that's sort of the cost, for per annual ton, to build this size of the plant that they need to do that. So they've gotten a $150 million Department of Energy loan. There's, again, a JV between Equinor. So that helps with de-risking this a little bit. So there's less capital or less exposure if you have a partner that has, in this case, 45%. If you take a hit, it's a less of an impact to the bottom line. But ultimately, this is a major project for this company. It's really kind of a make or break deal, I think. And if you look at it from an operating cost perspective, so that's like just the initial investment, right? So they're going to have to make a profit and over a number of years to pay back that initial capital investment. The numbers from an operating cost perspective break down to the numbers, say $4,800 to $8,000 per ton of lithium carbonate equivalent, and that's including things like the pumping and the brine, getting the brine itself, processing it, the conversion, and then the overhead and all of those things. Doesn't include, I don't think that mentions anything about drilling costs and things like that. So they're having to drill new wells and build infrastructure around that. That's on top of this. But if you're talking about, let's just say $5,000 to $7,000 per ton cost, and prices are like $10,000 right now, then that, on paper, Justin, it seems like it would cash flow. Now, compared to traditional lithium production costs, here's some numbers here. South American brine, that's the evaporation ponds, it's $4,000 to $6,000 per ton. So I'd say it's just a little bit more than that cost-wise. China, they produce it, according to this, $3,000 to $5,000 per ton. And then some of the hard rock Australian production, it's $8,000 to $12,000 per ton. So this is more cost effective than that for sure. So you look at it, it's kind of in the middle from a cost perspective for these direct lithium plants, but it's faster to get online and faster to start producing that lithium carbonate, especially versus those evaporation ponds you mentioned, Justin.
Yeah, you said it, Matt. And it also kind of plugs into and takes care of a byproduct of another industry, which has some benefit as well. That infrastructure is already built out in Pennsylvania and places like that. So I think that's part of why we're seeing such rapid adoption too, is that these systems in large part exist to provide the supply, just not the processing. And so, Matt, for revenue analysis, when we're looking at price context, at the current spot price, which let's say is $10,500 a ton, the gross revenue would be $315 million a year, less that operating cost of $6,250 a ton average, which leaves us at $187.5 million. And that leaves an operating cash flow of $127.5 million a year. Of course, less depreciation, $35 million. And then tax incentives and credits come in as a positive at $92.5 million a year. So, Matt, they're making money, but this is certainly not, they're not knocking it out of the park.
Yeah, based on this, it seems like it would take them probably 4 or 5 years to pay back that initial investment. And so, again, if you look at the full break even over a 20-year project life, say 10% cost of capital, my AI assistant ran the numbers, and the required price for a 10% IRR, which is a pretty low IRR for a capital project that you're going to go spend $500 million on. They need $15,800 per ton. So you break that down on the current price versus the break even, that's about a third, so $5,300 per ton shortfall. So, all those numbers we just mentioned are sort of pre-tax credits from the Inflation Reduction Act. And of course, that is, the Trump administration has been very supportive of standing up industry in the United States. So I think that domestic lithium production's in the crosshairs, and they want to see that happen as well. Certainly the Biden administration had provisions in that Inflation Reduction Act for lithium, and that those credits that are in place basically is about a $625 per ton benefit for those extraction, processing, and refining steps. And then it's a critical minerals. And so there's a tax credit for critical mineral production, which is up to 10% of the extraction costs. And so that's another $400 to $600 per ton. So you're looking at, based on that IRA wording, it's $1,000 to $1,500 per ton benefit to the bottom line. And then again, you have a $150 million DOE loan that was granted for this particular project. The interest rate is below market. And so they save money on interest from the credit facility that they would have needed. And that's equivalent to about $200 to $250 per ton. So you add all that up, the total, I'd say subsidies from the government is on the order of $1,200 to $1,750 per ton. So effectively, if you're getting $10,000 per ton for the current spot price, you have your subsidy of around $1,500 per ton. You're effectively getting $12,000 per ton, which is still below that break-even number that we mentioned of $15,800, but it certainly gets you closer.
You said it, man. And, to compete with supply and demand of the market being flooded, we've got to get production up to be able to compete. So I think that's a huge part of it. And Matt, even if they're kind of at a break-even point, long term, I'm sure lithium prices are only going to go up. We would expect that. And I'm sure it's going to go up drastically over the years.
Yeah, that's a great point. And if that does happen, we mentioned the current market, which you could call it pessimistic or whatever. The market has been expecting prices to go up as the demand for lithium batteries continues to grow sort of exponentially as more and more EVs hit the market. If that all plays out like they're expecting, the forecast is talking about lithium prices up to like $18,000 per ton. And in that situation, if the price next year or when this project goes live in 26 or 27, and if it's $18,000 per ton, the economics of that project, you'd be looking at pre-tax income of $330 million, cash flow of say between $230, $240. And that's a very attractive project, an internal rate of return of around 35 to 40%. And you'd be paying that back in like 2 to 3 years. And that's more akin to like an oil and gas, like a shale well, to be honest. That's sort of the economics that some of the better wells in like the Permian and some of the top economics of core areas. That's the type of the numbers that we're seeing, like 30 to 40% IRR. And so that's a very quick payback, very attractive because they can reinvest that cash flow and then start to drill more wells. In this case, if this plays out like that, they could reinvest it in building other plants and other basins. So you could see a scenario where maybe Arkansas is the first sort of commercial project, and then they go to Pennsylvania or go to the Bakken, some of these other places where it may be economic, and then start to do the same thing there, and then you get this industry start to grow and fill that need. Because even with this first project, that 30,000 tons per year is quite a ways from the 500,000 per year that we need to sustain the current demand, and that demand's only going to grow, like you mentioned, Justin.
Yeah, you said it, man. And, from 30,000 to the over 100,000 a day that they want to produce with this one project, that's also a really big gap. And I can't imagine what it would take to get from that first point to, 100,000. But, right now they just have a demo. So we're headed in the right direction.
Yeah, that's right. And now I think it's worthwhile to mention the other scenario that's possible is that China dumps lithium on the market, tanks the price to try to put these producers out of business. If the price goes down to $8,000 per ton, the pre-tax income would be $22 million per year, or $15 to $20 million annually after all of that. And with $500 million in capex, you'd be looking at payback in decades, and that would be not acceptable. So I think in that scenario, if we were serious about standing up a lithium industry, then the government would have to step in. Otherwise, these companies are going to close up shop and not do this because it wouldn't be profitable. So that's really the other scenario, is that the government has to step in to, if this remains a strategic, asset that we need to be producing more of, then the government needs to come in and help these industries out. And that could be a scenario as well. And certainly with what we've seen with like the electric vehicle market, that is a distinct possibility, I will say.
You said it, man. And to put it in perspective overall, in the current market, you're talking $80 to $90 million in cash flow a year. And in an absolute best case scenario, unlikely best case scenario, you're talking $380 to $390 million annual cash flow. And so it's certainly not, the large moneymaker or the hidden deal that a lot of people are thinking that it is, at least not yet. Now, as they get these facilities up, it'll get cheaper to produce this. And I'm sure we'll see that as time goes on.
Yeah. So the bottom line, I'm sure many of you are wondering, okay, what does this mean for me? I'm a royalty owner. How much am I going to make on these lithium projects? I don't care about how much the company's making. I want to know how much I'm going to make. Well, there's 3 different scenarios that we ran numbers for. And again, you got to take this with a grain of salt, because this may not reflect the actual lease terms and the actual way that the royalty is calculated. But if the royalty were just a gross revenue royalty, so similar to a oil and gas lease with no post-production deductions allowed, that if you had $18,000 per ton in lithium price, which is kind of on that high end that we mentioned, 30,000 tons per annum, gross revenue of $540 million. And again, this is not reality because they're making 2.5% royalty on lithium, but if you had like an actual like oil and gas lease terms, there was 15%. All of the royalty owners would get $81 million per year. And if you had 1%, that'd be a huge percentage, by the way, of the royalty interest. That'd be $810,000 per year. Unfortunately, Arkansas passed a statutory royalty rate of 2.5%. So with gross revenue of $540 million, we're looking at $13.5 million per year across all the royalty owners. And if you had a 1% interest, that's $135,000 per year. So just goes to show how impactful that decision to decrease the royalty rate to 2.5% was on royalty owners' bottom line. Now, I'm not sure exactly how it's going to be calculated in other places. If it's going to be net profits, I doubt that would be the case. Typically, they're going to want to either do like probably a percentage and then they'll have post-production deductions. So that scenario, like in East Texas, where maybe they're getting 12.5% royalty or 15% royalty on lithium production, that example that I gave would be potentially what you could see if you're, again, looking at across one of those total plants. Now, more than likely, what's going to happen is it's like natural gas, right? You have gas that's produced at the wellhead. It's not in a saleable form because there's all kinds of impurities in it. It's got natural gas liquids. It's got, water in there. So they have to send it to the gas plant. They have to strip out the bad stuff, separate out the natural gas liquids and sell those separately, and you'll get paid for that. And then sell the natural gas as well. And then in between, many royalty owners are faced with what's called post-production deductions, which are basically having to pay your proportional share of any transportation, marketing, processing cost. And that can bring down the royalty rate, effective royalty rate significantly. I would expect that to be the case here in these lithium projects because the brine itself, as it comes up out of the wellhead, is not valuable until the lithium carbonate's extracted out. So I would expect you to see, maybe you have a 15% royalty, but then I would be expecting to see, unless you negotiate no post-production deductions. And that's why that is so important, like we always talk about. And if you can do that, that would be a home run in this case. But I would not be surprised to see things like transportation costs, and the cost for separating out the lithium, and then you may be ending up with like half of what you were expecting in terms of the royalty payment after those expenses are pulled out. So that's certainly worth hiring an attorney to get you the best lease possible that minimizes those expenses. And that's why we always say that.
Yeah, you said it, Matt. And it'd be worth the time to hunt for a good attorney too that might be familiar with this. In some areas you're more likely than others, but it would be worth your weight in gold to have some experience.
Absolutely. All right, well, let's wrap this up. I think the key takeaways here is that these projects are highly sensitive to the lithium prices. It's probably going to require government support initially, particularly if the Chinese flood the market with lithium to crash the prices. You see Arkansas leading the way. That's going to be where you're going to see the first commercial projects. And then I would expect the Permian Basin to follow closely behind. And then it seems like the Pennsylvania, the Appalachian Basin to follow then after that. But I think really that, these projects need around $15,000 per ton. There's about a $5,000 per ton gap right now to where they need to break even before tax incentives. After those tax incentives, that comes down a little bit. But even still, we need prices to come up a little bit for these to be like really profitable ventures. So, and again, that's before taking into account the royalty regime and all of that. So that's why Arkansas, if you had a company that has interests in the Smackover, I would go to Arkansas first because of that royalty regime. You're going to keep 10% more in that revenue just because that royalty rate is much lower than what, the market is allowing. So I think from that standpoint, that's what I would expect. We'll put the resources we mentioned in the show notes where you can do a little bit of a deeper dive and look at some of these numbers if you're interested. But again, the takeaway here is from mineral owners, negotiate the most favorable terms possible, get a competent attorney to help you with that process. That's probably the biggest takeaway here. But it's going to be interesting to see how this market emerges and if we can stand up a domestic lithium production up to where we need to be to meet global demand, or at least domestic demand initially, of that 500,000 tons per year. It would be cool to see that happen.
You said it, Matt. And for mineral owners, keep your ear on the ground for things going on in your state where you own minerals about lithium and what precedents are being set there. Because throughout 2026, I'm sure we'll see more of them follow suit.
Absolutely. All right. Well, that wraps up this episode. Thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.